Welcome back, everyone, to the New York City Multifamily Podcast. To my left, my partner and friend, Joe Koicim. Today, we are joined by our dear friends at MMCC, Marcus and Millichap Capital Corporation, Chris Marks and Steve Filippo. Boys, welcome to the show. Thank you very much for joining us.
Thanks for having us.
See you guys. Our pleasure. Absolutely. So, little background. I'm going to, tee you guys up here a little bit. Chris, you and I were chumming it up in the Cubes back in 2009. I think you got here maybe 6 months ahead of me, something like that. And Steve, you just passed your 10-year anniversary.
I did.
At Marcus, so congratulations.
Thank you.
You guys, 1,100 deals done, $3 billion in dollar volume over the past 15 years. Congratulations on all that. We're sitting here in the beginning of 2024, and I think a lot of people are very happy that 2023 is beyond us, especially when they start thinking about their capital stack and the debt side of the business. How do you guys feel about 2024?
Happy 2023 is over, obviously. I mean, obviously last year was tough. First half was, decent for us, but second half really kind of dropped off the cliff. But, a couple of things happened there. Obviously, we had a couple of banks that failed, and, that sent ripples kind of through the marketplace. And, rates spiked up. Treasury bills were over 5%. I mean, rates were getting quotes somewhere between 7.5% and 8%. And, there's pretty much nothing going on. So,
yeah. That was their way of saying, I'll give you the money, but only if you really need it.
Yep, basically.
Right.
Yeah.
Sort of saying they're lending, but they're not.
Yeah, they're
priced out of the market.
Right.
But Chris, you predicted that the 10-year was going to get back down to 4, right?
I did.
You told me that.
Yeah. I made a lot of money on that.
Ball.
What has been, so we're well into January right now. What's been the tone, like when you call your buddies at the banks and you're asking them to price a deal, how would you say the attitude on that phone call is today versus maybe in Q4 of 2023? What's the tone like from the lenders right now?
We're seeing a lot more optimism for sure.
Yeah, I mean, it's a completely different tone. I mean, obviously, new year, new allocations. I think a lot of guys were kind of just hitting the brakes last year to kind of see what happened, let the dust settle a little bit. But we're, game planning on coming back pretty big in 2024. I think banks are still being somewhat conservative, but it's good to see a lot of these groups that were kind of on the sidelines come back and start lending again. I think it's good for the overall capital market.
Let's talk about the allocations, because there's a lot of new banks coming into the space, right? Without mentioning names, what do they look like? Or have they not been in the business in a while? Are they just re-entering? Is it new lenders? Is it newly formed banks? Tell us.
So, I mean, the history, obviously, over the last 10 years, there's probably the Power Three that we all know who they are, who's done 80% of the business, and that has completely changed.
Well, one's gone, right?
Yeah, one's gone. We lost one along the way, and the other two have pulled back pretty drastically. So, we are seeing some newer banks step up. I've been through cycles before, and it's pretty funny. Some of the banks that are stepping up are ones that stepped up during the last cycle and kind of went on the sidelines when things were really, booming. But, we're seeing a bunch of new banks come to the marketplace. I mean, Fannie and Freddie are always pretty active in the multifamily space, but, we are seeing these local and regional banks kind of step up to the plate and fill some of that void.
So who is filling the signature bank void? Like, who specifically?
I mean, no one really. Yeah. I mean, what they were
those
doing.
Are huge shoes. Those are huge shoes.
Such a unique situation.
I mean, it's going to be tough to fill those shoes.
Yeah, one of the things, maybe like to compare our businesses, like Joe, when you and I get a call, like a random cold call from a buyer and says, hey, I'd like to buy something. Me and you are like, all right, are you actually going to buy this? Like, are you a real buyer? Is it the same for you? Like, are you a real lender?
Yeah, how are you vetting them?
One of the things that we've heard from borrowers and buyers out there is that, the bank goes to the edge of the diving board, and then when they either dig into the diligence or, maybe talk to their buddies, whatever, they get scared just like any other buyer would. How would you kind of comment on that? Do you think that's happening a little bit?
We don't run into it at the end as often. It's more up front because we do a lot of due diligence up front.
Ton of vetting up front.
You've never been left at the altar.
Well, we're hearing like all these banks, like, they'll
not unless something popped up
unforeseeable
that
circumstances,
outside of our controls.
But like they don't get, are they retrading? Like this is what we're hearing all the time. Like the guy signs the contract, he's promised one thing from the bank. 90 days later, he's ready to go to a closing table. And then the bank says, hey buddy, I didn't know X, Y, and Z. I can't give you 10 million. I can give you 9 million or whatever it is. And they're and then the buyer's like, oh, hey, Mr. Seller, I don't have that much money.
If due diligence changes during the process, or like with the information the lender had changed, and then by closing, they're using completely different numbers.
Yeah.
That's explainable, you know?
So
I mean, I think the biggest thing last year was just so much volatility in yields that, you know, if you didn't go into something that was locked at application, there was very high risk that your loan amount was going to change, or there's going to be a drastic movement in something because rates have moved drastically. We had a couple of loans where, you know, we lost, 10-15% of the loan amount because yields bounced up 75 bips during
that will do it. Yeah.
But we were lucky mostly last year.
Yeah.
I feel like probably 90% of our loans were rate locked, right?
Yeah. I mean, we have a handful of guys that are pretty aggressive in the marketplace that are doing swaps that don't lock until closing.
Right.
And that's where the risk is. And we had a couple of deals where, rates did pop up on the deal. But, flip side of that, we had a couple of deals where we went under application and our rate went down by 75 basis points at the end of the year. So
and that helped push proceeds,
right.
As the rates drop.
But how are you making borrowers comfortable today in 2024, preventing that from happening? Obviously, some of it's out of your control.
Yeah.
But, it's managing expectations, understanding where the lenders are coming in and how things are moving on a day-to-day basis, right?
I mean, for us, it's important to really vet a deal out before we bring it to market, right? Or if we're going to start, we want to make sure that our stuff is tight, where we're not going to have any sort of retrade or anything that's going to come up on us that we missed, right? So we spend a lot more time up front kind of looking at the diligence and making sure our stuff is tight. But I think when looking at rates and looking at programs, we're running a marketing process, especially now. I mean, we're going out to 50 plus lenders on some deals and building a marketplace from all different capital sources, showing them the complete market. And we're talking through the codes and pros. Like, listen, you can get 3/4 of a better rate by doing a swap, but there's risk that you're not locked, and we're going to float for 60 days until closing. Do you want to take the risk? And most people will say yes.
For a straight multifamily New York City property today, are there 50 plus lenders coming in with bids? How many of bids will you get from that?
We'll send it to 50 probably groups because, we'll try to pull from Jersey, Connecticut, Long Island, obviously the banks in the city, all the agencies, life insurance companies. It depends on the deal, right?
Sure.
But if we're running a bigger deal, bigger process, we'll go to pretty much all the capital sources. Realistically, now we're probably getting 8 to 10 good bids, and we're honing that into the top 3 to compete against each other. But,
It's interesting too, because, when things were perfect, call it 18, 24 months ago, you could reach out to a handful of lenders and they would all be within call it 25 to 50 basis points of each other. Now you reach out to the same bucket of lenders, much wider, man.
Why is
There's
that?
guys like in the mid 5s on the low end, upwards we're seeing 7s and 8s.
Yeah. So what is that about?
Crazy.
Like, why their cost of capital is? I'm making kind of a broad statement, but the 10-year Treasury is the same for Bank A as it is for Bank B. Why does
with some of these lenders?
So what can you expand on that? Like, why does one bank give you a quote at 5.5% and one bank gives you a quote at 7%?
It's typically the larger, well-capitalized banks that are following Treasury yields down, whereas some of the smaller and regional guys that may or may not have, liquidity issues, they're the guys that are kind of strapped to following the Fed's guidance, and the Fed hasn't lowered rates yet, even though Treasury yields have come down. The Fed hasn't made.
And so these regional banks, everyone's looking for that nuanced buyer, and you're looking for the nuanced bank, right?
Sure.
To give you the best deal,
right?
And maybe it's not Chase or NYCB or now defunct Signature, but it's kind of that random community bank. Do they have any money? In this conversation,
a lot of them want
you
deposits.
drive around these banks and you're there's no one in the parking lot. I've never heard of this bank, yet they're there. Are they actually giving you competitive quotes?
Some are.
I would say
closing?
The guys that were the most active are probably, the least competitive. I mean, we're getting bids where there's some serious depository relationship involved. Rates are wider than, other smaller regional banks. And you can just tell they just kind of want to, kind of ease up and maybe just hit the brake and not do as much. But, to Steve's point, there are some bigger regional banks that have, don't have liquidity issues and are putting out cheap money. Now, they're going to be very conservative on their underwriting. They're going to want strong sponsors, no background history, et cetera. But we're getting deals done still in the mid to high 5s right now, given where yields are at 4.15.
Well, let's talk about that. The best rate you've quoted this week, today's Tuesday, but let's do it this week because I know you guys are very active on a straight multifamily New York City product with maybe 20% stabilized.
Mid-high 5s.
Mid-high 5s. Are you getting any interest only?
Depending on sponsorship, I would say like 1 to 3 years. But, it's just,
Okay.
it
But that would
depends
be on
on
a lower leverage.
And what are we talking about leverage point on,
It's all it's not all, but most deals, as you guys know, they're cash flow constrained. It's
Yeah.
DSCR constrained.
where do you see the DSCRs coming right now in terms
For
of
straight multifamily, we haven't seen that move much, right? It's still 120 to
125.
130.
Across product types and geographies, what gets the lowest rate in the market right now? What type of product type?
It's called office.
Is it
Yeah.
is it office? Is it Class B office?
Vacant office.
Yeah, no.
I mean, that doesn't
Is
get a
it,
quote.
is it single tenant?
Yeah.
You know,
So I would say
Wawa?
it's
What is
not. We can't break it up by product type, right? I would say it's by location. So the way we look, because we do a lot of national stuff, right? So like we deal with banks across the country, and where we see the most competitive rates are, I would say, is like New York Metro, tri-state areas, where and then down in Florida, there's a lot of very aggressive banks right now. And there, if we have something decent, good multifamily, strong industrial, strong single tenant credit with long-term lease, and that's where we're seeing that like mid-5 to high 5 range on a 10-year note, 30-year AM.
It's more about geography.
Yeah.
I mean, obviously, asset class matters,
Yeah,
sponsorship, quality of the deal. But like he's saying, depending on what region in the country you're in, rates could be totally different,
And
depending on how robust the lending marketplace
But
is.
like, why is that? Because they go like in and out of, right? Like the lender gets hot and then they pull back. Why are some lenders? Why is it?
It sounds like
Why is it
applications,
so geographically nuanced?
I mean, I
like
think
that?
it's just the competitive nature of the banking markets in those areas, right? Like you look in, the tri-state area here. I mean, you have some of the biggest banks in the world competing for business, right? Same thing goes for Florida. I mean, you have a ton of money in Florida, so these banks are looking to put out cheap money, and they have a lot of money in deposits.
Right.
You go into some other markets, and I can tell you, like when we advise clients, and they're in a 1031, going all over, coming from New York, and going into different asset classes across the country. Like the first thing I say to them is like, hey, try to stay in these areas because you're going to get about 50 to 75 bit better in rate than if you go into Texas or even California or Chicago. So,
Yep.
Especially Chicago today, right?
Yeah, it's very location driven.
What that's interesting. Around due diligence, I want to hone in on this. This is where Joe and I spend way too much of our time, like just getting through due diligence. Sometimes we sell deals without like getting any type of expense back up, and then the mortgage broker calls us and they're like, "Hey, I need this, this, and this," and we try not to hang up on them. but like, in terms of going back to like the banks doing due diligence, is it really nuanced? Like bank A wants X, Y, and Z. Bank B wants, only A, B, and C. Like kind of how Joe and I will know two different buyers. Like one guy will want to give the building a colonoscopy on the paperwork, and one buyer will just give it like a really basic physical and be like, yeah, I get it, and I'll buy it.
Yeah, the banks
And,
have
like,
different appetites.
They
for
have
risk,
appetites
right?
for
Some of
risk,
them.
and like,
I mean, I think it's different, right? Every bank is going to underwrite a deal differently. They have different guys that look at things differently as far as underwriting. Some banks ask for tax returns, some banks don't. But I would say across the board, we've seen, people doing more due diligence on deals.
Right.
It's not just multifamily; it's across the board.
But on multifamily though, right? How
Yeah.
often are you seeing banks ask for lease reviews, DHCR checks?
Especially now.
So what's happening
now,
there, and how are you helping streamline that?
I mean, we're just trying to be as thorough as possible up front and make sure
Gotta
it's
get
a
in
complete
front of it.
package.
Yeah.
So, I know it's annoying, but when you guys are trying to slam a deal together and we're hounding you for really detailed information, we know what's going to come up, and I'd rather deal with it up front than 2 months into a process and then have it blow up a deal.
Yeah,
right?
we're getting requests for T12s on every deal.
Yeah.
T12s,
100%.
right.
That didn't exist in New York for the
Yep.
20 years that I've been
Absolutely.
doing it until the
Yep.
last,
Yes.
called 6 months.
Yep.
So not just from the agencies, but from regional banks too.
Correct.
okay, so when
We're focused on rent collections now more than ever. I mean, everything.
Okay, so our setups will show one thing, and then the T12 will show something totally different, right? There's like
Right.
200 expense items on these T12s. How do you guys actually get around that?
This is a very nuanced
You
question.
gotta weed
Be
out-
careful how you answer this question, guys.
You got
I
to weed
know.
out what's reoccurring. If you're talking about like repairs and maintenance, for example, what's reoccurring versus like a one-time expenditure. There's easy stuff like that. I mean,
Yeah, I mean, we're not deleting anything. So.
Yeah.
I mean,
Definitely
I think
not.
it's about.
Great disclosure.
Yeah.
There you go.
You can keep your job. Yeah.
You're welcome,
Yeah.
Chris, for that layup.
I mean, I think there's been a lot of news about stuff like that in the past, and that's something that.
No, but like
we
that's
want-
not, you're not being malicious. Like this is just the reality, right? Like the buildings, especially apartment buildings, it's not like showing a T12 on a shopping center or a net lease where it's like super simple. On the apartment buildings, around this conversation about diligence and hurdles that we have, right, are, you know, T12s and kind of having to go line by line and explain stuff. And I'm kind of
That's
curious,
exactly
like,
what we're doing.
what is that how it is, like hand-to-hand combat? Like,
I mean, on every single deal, it's not going to line up to the broker's package.
Of
right?
course
So,
not.
like,
it almost
so
This
for
is
us,
never does.
yeah, this is
pretty
not a
much.
secret. I'm not saying
Yeah.
anything that's like hidden information.
Either there's 1,000 emails back and forth between the underwriter, my analyst, and the deal team, or we just most of the time we'll jump on a call and go line by line and just explain it all.
This is
But
where,
we actually put vacancy and management fees, like some brokers
yeah.
don't, you know, we actually do that.
Sure.
this is where I think the brokerage
So-
world is evolving in like,
Yeah.
and it's the same on both sides of the business where like the amount of hand-to-hand combat and questions that we have to answer on both sides of the business, on the sales side and the brokerage side, is like really changed. Do you guys notice this? I mean, over the
Yeah.
last 10 or
There's no
15
cutting,
years?
there's no cutting.
Yeah, it's not like, oh,
No.
slap it together and
Yeah.
you're done.
Everything's gone through with a fine tooth.
Yeah.
I mean, I think the value of having everybody under one roof is huge, right? Like, it's like if there is an issue that pops up with underwriting, I could run to one of your offices, grab you on a call, and get it solved within a half hour. Where if we're not in the same office, we might have to schedule a call. It might take a day, whether it's a day of the due diligence or whatever. But
Extra brain damage.
you know, it's
Yeah.
definitely more Q&A and there's a lot more communication and walking people through. you know,
Yeah.
the
What,
line by line.
what are you seeing from a timeline perspective with these banks? Are they taking longer to close, right? Because that's
It's a
what
little
I'm
bit
hearing.
longer to do the.
You know, everyone's asking for more, you know, contract period time. Yeah.
I mean, I think that, you know, when looking at multifamily, 100% is taking
Yeah.
a little bit long because people are concerned. They're going to do a lot of due diligence. They want to make sure the leases are tight, make sure there's no issues with any of the tenants. You know, I think when you're looking at some other asset classes where it might be a little bit easier, where it's one or two leases, one lease, et cetera, like those timelines haven't really moved that much. But for the more complicated deals, we're seeing like an extra 15 to 30 days.
And are the rates on the more complicated, hairier deals a little bit more expensive?
I mean, if the hair is like credit or violations or stuff like that,
Yeah,
Definitely.
it's going to get priced into the deal.
yeah.
Are you seeing a lot more
This is-
holdbacks? Are you
well,
seeing a lot more holdbacks and
It
escrows?
depends on what it is.
Yeah.
Like if there's, you know,
violations.
violations,
You know,
all the
Circum-
stuff, you know.
circumstantial.
This is like, I'm curious if the banks kind of operate the same way our buyers do, where you're explaining the deal to the buyer and the buyer's like, too complicated, messy, like price reduction or anything like that. Are the banks the same way? Where
Yeah, how
they
much are
have-
you articulating the
you
deal
You know what I
story,
mean?
right?
Are the
There's
bank's
been,
like, this is a little too complicated.
If it
I'm at
start-
7%.
So if it starts to they'll get deal fatigue for sure. Like,
Yeah.
you start to sense it.
Yeah.
So this,
like,
so deal
You gotta
fatigue
finesse
exists,
it.
Yeah.
even
Definitely.
you know when they're putting out money that's not
so
actually.
Stephen, let's talk about that a little bit. When you say finesse it, like you're telling the deal story to the bank on why the borrower, like who the borrower is, why they're buying, and what the business plan is.
Correct.
Because how much of that has changed now because of, you know, some of it, there is no business plan because you're buying rent stabilized product.
Right.
But, you know, how has that changed for you and how are the lenders, you know, kind of reacting to it?
I mean, listen, you probably agree, but I think it's just, again, being thorough with lenders on the front end. In terms of finessing it, you know, if there are certain qualities of the deal or hair on the deal that need to be disclosed, we try to get in front of it, but we don't necessarily want to tell them that right out the get-go on the first email. We want to get them acclimated to the high-level information on the transaction. What kind of property is it? What's the business model? Once they express initial interest, then we disclose it. But it's a steady balance, right? Because you want to be upfront with
You're
these
getting,
lenders.
you're getting them
Yeah.
pregnant. It's the same thing. If
Yeah.
if you walk in and you're like, hey, here's everything that's wrong with it, they're gonna say, nah.
But at the same time, we don't like hide things. Like we're very good at flushing things
Right,
out on the
yeah,
front end with
right.
with lenders because we never want to ruin our reputation
Sure.
with a broker we're working with or with a lender. That's our life.
I mean,
Right.
sponsorship is so important though too. Like
Experience.
they're looking at so many
financials.
deals. It's like,
Yeah.
all right, listen, you know, this client owns 15 buildings, has a net worth of $50 million, and has
Yep.
$6 million at NYCB. Like, I could potentially, if we do this deal well, get you in front of them and potentially help you move some of those deposits over. Like, these are the type of conversations we're having with bankers to try to get them interested in the deal. We're not guaranteeing the deposits, but like dangling the carrot.
Yeah, they are
And
salivating.
you need,
over
and you
these
need to do that
deposits.
because the banks
Oh, yeah.
need deposits.
Yeah.
I mean, and you could tell which banks are the ones that are having liquidity issues and which ones aren't because they're putting it in term sheets like, hey, I need 10%, 15%
20%, like
20%.
Oh, we've seen 20%.
Hey, I'll give you a loan, but you got to
Yep.
give me 20%. So I
How much better are they? How much
lend it back to you at a
How
higher
much
rate.
better are they doing at the rate?
And the rate's not even better.
No,
Wow.
rates are the same.
So that's just like mandatory now.
Yep.
So,
Some of the
how else
lenders-
have they been stringent this, in the last couple of months? How's it changed?
I mean,
Besides the
leverage.
diligence,
It's
deposits.
just a natural thing. Like
Yeah.
the leverage is going to be low, just kind of giving that cap rates haven't necessarily moved, and rates are obviously a lot higher than they were 2
Yeah.
years ago. So I think leverage has always been somewhat of an issue over the last 12 months. But as far as underwriting goes, definitely tighter on like definitely checking background checks. Checking older buildings that they might have sold, see how they ran them. Like there's stuff that they used to didn't like. They would just pass through. That things pop up. Like
They're turning into like little private investigators.
100%.
This is interesting.
Definitely.
What we've heard a lot about personal guarantees over the last 18 months or whatever. Are you guys seeing these kind of stick around a bit? Because you quoted me you guys quoted me something just personally for on a personal guarantee for my own property.
Right.
And I was really surprised by that actually, and it was kind of outside my comfort zone. But do you guys think that personal guarantees are kind of here to stay? And is this kind of like the new future a little bit of the lending environment?
Tough to say. It's definitely more
Deal by
prominent
deal.
now, for sure. Because again, everyone, including lenders, are a bit nervous about how things have been shaken up. I would hope, I'm sure you guys would all agree, that as things get better and the market continues to stabilize, that a lot of those recourse requests go away.
But you're seeing partial recourse, right? You're not seeing like
We see it across the board.
Yeah, yeah.
I mean,
The whole
depends on
spectrum.
Deal,
Yeah.
like leverage matters, sponsorship matters,
Right.
Yeah.
deal size actually matters. Like,
Sure.
when you go above 5 million and you're dealing with more sophisticated lenders, like they're used to non-recourse because they're used to institutional sponsors. So all that stuff matters. And the deal you did obviously was a tougher one.
Yeah.
Single tenant deal, but I think it was more of a loan amount and credit, but it was a great deal. But on
Well, let's talk about it a minute.
no, but
No.
on those types of deals, it's a smaller deal. Not a huge credit. Wasn't investment grade,
Yeah.
The
right?
tenant. Yeah.
Right?
No, my tenant was corporate.
Was it investment grade?
Yeah.
I don't know.
Sure it was. He doesn't know. He doesn't know what he bought.
That's
The nuances in
good
that
job.
lease.
Yeah.
But
Minor
let's talk a little bit about, right? Everyone wants to know distress, right? There was all this distress come from the banks. But before we talk about distress, all the loans you gave 5 years ago at 3.5%, whether it's multi, single tenant, net lease, they're coming back to you. They say, "Hey, Chris, Steve, I need a refi."
It's a great conversation.
Yeah. How? I mean, that conversation is happening a lot. So
First response is, I hope you have a rollover option.
right. So how are you advising those clients? And what's happening? Are some of them doing the cash and refi like we're seeing?
Yes. So we're doing some of those now.
Okay.
Some people are selling them.
Yep.
Some people are.
We haven't gotten a call from you in a while.
What?
We haven't gotten a call from you. Okay.
Well, we do a lot of different product types, but we got a lot of that stuff, and we're doing a CVS portfolio now where guys coming in with like 10% cash because we did a 10-year IO loan 10 years ago, right? And we did it at full leverage, and
the real question is, what cap rate did he buy 10 years ago, and what's the cap rate today?
Very
Oh my
They're
God.
very similar, right? So
Right.
there's no,
really, and those are flat leases, so there's not really any appreciation. But and we have other ones where it's like the loan amount is the value of the property, and those conversations are difficult. But there is, the first conversation is, let's get on a call with your attorney, let's talk through it, let's see what we might be able to do here, and then let's get on the phone with the bank and see what they're willing to do.
And what are the banks actually saying in most situations like that? Are they kind of clawing at, bad boy carve outs? Hey, I know there's no personal guarantee on this loan, but times have changed.
They're going to want some additional collateral, or they're going to want some recourse to extend.
Yeah.
And we saw this during COVID. When all these tenants were looking for rent abatements. And then they were running their bank trying to get modifications.
Yeah.
Like these banks came back and were like, all right, we'll give you a modification. We'll give you 6 months of no payment, but we want to get rid of your option, or we want to bump your recourse from 25% to 100%. And
so are clients actually doing that? Like if
it's unfortunate that some have to, right? They don't have any options.
And so what is the profile of that client that is opting to stay into the deals? Or like, are these
Profiles like-
syndicators, high net worth
Ones that have
guys,
cash.
long-term
They
owners?
They have enough cash.
They have
on
enough
These
hand.
are
money.
like genuinely wealthy individuals,
Wealthy individuals.
not like fake rich.
They want to
actual
stay
rich.
in the deal.
Yeah.
They had the cash on hand to pay down the balance, satisfy
Yeah.
the lender,
Yep.
push out the loan.
Yeah.
The guys who are syndicating, it's tough to go,
No, they're
raise
losing.
Yeah,
capital.
they're asking for money, from daddy. Just right?
like
Yeah.
that's,
Yeah.
I mean, the biggest thing last year was like we were actually really busy third and fourth quarter working on stuff, but nothing closed. What was happening was all these guys that had loans ballooning were having us run a process and then basically using our market feedback and just going back to the
lender to get
saying, hey,
extensions.
this is the market.
Yeah, and the
We
lenders
can't-
were kicking the
it's not
can.
going to work.
Yes, they're
And
kicking
they
the
end up
can.
getting a year or two extension.
But
on
that's not happening anymore. Am I correct?
No.
Yeah.
We're
So that's
seeing
stopped.
less
that
of that.
stuff start to come
seeing
down.
much less of that now.
Yeah.
But that was definitely prominent.
So what are your predictions for 2024? Where, are rates going higher? Are they going lower? What are we doing?
I mean, I think rates are going to hover in like a 50 bip range. So I think, we're at 415 today. So I think, we go down below, 4, maybe even close to 375, and it could go up to, 450. But I think we stay kind of in that range.
How are you advising clients on when to rate lock and it's
I mean,
it's
if you
nuanced.
have the option to
Yeah.
rate lock and the rate works, like I'm telling them to lock it.
Okay.
Yeah.
In a situation where we don't have the option to rate lock, like we're just trying to push forward and get it closed as quickly as possible before there's real movement.
You're expediting the process.
yeah.
where you can.
I mean, listen, we lucked out on a couple of deals that closed over the last 3 weeks where, we started, the rate was, close to 7% and we closed in the high fives.
Yeah, we're hearing
It's a
that.
big drop, right?
Yeah.
So,
Yep.
hopefully that continues and we don't go from 415 back up to 530 because I
That'd be a
think
big
that
jump.
will be a
Right. But the agencies, I want to just kind of get into the weeds here a little bit about what's maybe the biggest difference right now between like the local savings banks and the agency lenders, and kind of where you're seeing the biggest difference between the two of those types of loan programs,
Yeah.
and where you're seeing the clients gravitate towards now. And
Well, I
go
would say
ahead.
rate, right? Like
Yeah.
rate. Typically, like if you have down the middle deal, lower leverage deal, like they're going to be very competitive.
The agencies you're talking?
Agency.
Okay.
Agency.
Okay.
But I think we can also match that or even get better with a swap lender. So, without having to go through the hurdles of going through an agency loan, which is, a lot tougher than doing.
It's cumbersome.
Yes,
right?
yeah. So let's talk about that because there's risks, right? Like
And-
some people chase the rate.
And especially
But there's
now, given all the stuff that's happened over the last 6 months, they're scrutinizing the broker stuff more and more. So it's even harder to get through the process. So, for us, like if we have something that's on the table and they're very similar, if we don't need leverage, like I'm advising to go with a bank, right? But if it's something where it's like, hey, we have a client that needs a refi, we need 72% leverage, like typically the only way we're going to get there is either CMBS or agency.
And the downside is yield maintenance penalty.
Yeah.
Right,
higher
so-
prepays.
Yeah, or
But-
defeasance.
But agency's
Or-
always non-recourse. And
It's
they're-
always
non-recourse.
it's always non-recourse.
Always.
Okay, so for the
So
so
more
for the
stringent diligence process.
Yeah, they're
Yeah.
hyper focused on.
And what about, I'm doing one right now where there's about 30% of the income coming from the retail, which I was always told that agency won't do that, but they're doing it. So
Yeah,
has
there-
that changed a
there's
little
cutoff.
bit?
You can
Yeah.
get exceptions.
Yeah.
Exceptions.
Yeah.
Right? So like there are like
Corporate guaranteed or yeah.
yeah, I mean there's
Yeah, it depends on the
parameters.
credit
Like,
of
it
the
depends on
tenant.
how strong the tenants are. The deal, the sponsorship. Like you can go in and get waivers on certain things. I mean, it's not like you guys are at 50% and you're trying to get full credit for it. Like that probably wouldn't happen. But if you're 5%, like a good lender will try to get a waiver and get it approved.
Interesting. And in terms of diligence between the two of them, would you say that there's a lot of similarities, or
Yeah,
are they like extremely different?
I would say it's a little bit harder on the agency side to get through.
Is it?
Yeah.
Agency's always been, even before everything happening now, always hyper focused on rent collections in
Property
particular.
condition reports.
Property
A
condition
lot more due diligence
report.
on that side.
Yeah. So this
So
is like, Joe, like when you and I are talking to a seller on a deal and you say, hey, you got two bids. One is X price and one is Y price. And the client's like, oh, I want the highest price. right? That's like their initial reaction, especially in like
Yep.
a market where the prices are down, but they're so nuanced, right? And we kind of got to talk about, well, this guy's never bought a building before, and this guy, owns 10 buildings in your neighborhood, but maybe he's a little bit lower. He's got a higher deposit, right? And I'd imagine you guys are kind of coaching your borrowers with the same type of way, right?
Today more than ever.
I think
it's all about
the surety of close,
execution,
the surety of close and execution is just like so important. It's crazy, especially with everyone people are doing exchanges, right? So you gotta, if you're selling, you're probably also lining up what you're gonna buy.
Of course.
And so you want to make sure that the buyer is actually going to close and not say, hey, I need another 45-day extension or something like that.
Absolutely.
Never a good call.
That is really a bad call.
Yeah.
How would you say, so you guys are financing refis as well as acquisitions.
Mm-hmm.
Yep.
What is an easier deal to get done, a refi or an acquisition?
Family is always easier for an acquisition because if there is some hair on the deal, like it was in our sponsor, right? So we can come up with a plan saying, hey, they're going to come in, clean up these violations, clean up the building, whatever CapEx work that needs to be done. They have a plan within the first 18 months. It's a much easier sell than someone's owned the building for 15 years and has a bunch of violations.
Didn't do anything.
Yeah, just wants to pull out from his piggy bank.
Take some cash out of the deal.
Yeah.
So, it's always a little easier in the acquisition.
Okay, so that's interesting. What would you say to a new borrower who
first time?
Yeah, like first, second time, like minimal track record. Maybe he's got a couple of shekels in the bank account, and he's like, hey guys, Steve, Chris, I want to get a loan. What would you say?
I'm going to be very honest. Like, it's going to be difficult if you have no experience to do a deal, that sizable deal. Like, if it's something small and he's getting into like a 6-family, 10-family, like we can sell that.
Or like a super clean deal.
Yeah. But if he's going into something sizable, like that has some hair on it, it's going to be very difficult.
There's certain lenders that won't even take it.
They won't even touch it.
They want to see experience, track record. They want to see their own portfolio. The deals with hair on them,
Are they so nervous? Are they so, like, what is...
Some more than others.
Yeah. I would say they're nervous.
They're nervous, right?
Yeah. Listen, there's some banks that are very confident, right? Their banks do very strong and doing really well, and they know that they're the top bank in the marketplace, and they're putting out cheap money, but they're being very selective. And there's a couple guys like that, and then there's guys that are not. There's guys that are having some liquidity issues, and they're being very, very cautious.
Well, they lent too aggressively on deals when things were perfect, and now things aren't as perfect. And,
we have like an endless list of clients who say to us, if I could just get my money back, I'd be fine. Right?
Yeah.
And do you think it's the same for the lenders in many situations where they would just want to get their principal back and kind of move on? Like, as part of,
I think
it's part of their gut. Like,
they want to make sure they have a clean book because they don't want to get fired, right?
It's a little different from a corporate perspective, right?
For them, it's like, I want to make sure, my 30 and 60-day delinquencies are little to nothing.
Yeah.
Right.
If not, if I have 5% delinquency at a 30-day late, and the other two bankers in the office have none, like, if there's cuts, I'm going to be the first one to go.
Okay, so we have God knows how many deals that we look at that are underwater, especially ones with a stabilized component.
Yep.
How do you anticipate the lending community addressing these types of loans this year? Because so far, like, for the most part, they've kind of put their head in the sand, kicked the can down the road. Yep. Let's get past 2023.
Let's hope rates drop,
let me get my bonus in January, whatever it is, like, not in this calendar year. How are the banks going to address these types of loans?
And I'm sure you're getting those calls already.
Yeah.
So,
and we're having the conversations too. We were having conversations with a bunch of groups. I think every bank's going to handle it differently, but, I think they're going to look for some sort of, credit enhancement if they're going to do some sort of extension. So either new collateral or maybe bringing money over to the bank or something along those lines. But, I think there is going to be some stress. I think a lot of it's been kind of kicking the can down the road over the last 6 to 12 months. And I think that's going to kind of stop, and we're going to see some stuff kind of start to, go south. And, I think some sponsors will just hand the keys over and get out. And others can't because their basis is too low. And if they do that, they're going to have a massive taxable situation, and there's going to have to be some sort of workout plan. I think every bank's going to handle it differently. Yeah.
So the workout plan, everyone's talking about like workout plans. How do you, Joe, you and I talk about this a lot, where the loan is maturing And the bank's like, yeah, like I just, I'm not taking a discount, man. I can't show that. No way. Well, all right.
The bank and
That
borrower
sounds
don't wanna
good,
show
but
their cards.
Yeah, but like here
Yeah.
we're here
It's
on
like
planet
anything
Earth, like this is kind of, the reality of the situation. So the value of the note is always going to be less than the current value of the property, right?
Hopefully.
Well, no, that's what it is, right? The value that it's always going to be less. You're not going to sell the note for more than the fee.
Oh, you're talking about when
I'm selling
Unless there's a light, like there's no light at the end of the tunnel, like in the 5 years or whatever. Like I don't see either one wanting to kick the can down the road. Just kind of
it's got to come to a
bite the
point.
bullet.
Yeah,
and
this is
It's
like
got
one
to
of-
come to a point.
Like this is one of the things that I wish the lending community, I don't know, either like understood or acknowledged. It's kind of unclear of where their position is, but like the discount is greatest when they do the workout in the dark.
I think that what you will see, this is what happened kind of the last cycle, is the notes will go up for sale, and typically if the sponsor's strong, they will figure out a way with some sort of syndication or partnership to go buy the note at a discount and keep the building. Maybe bring on a JV partner, etc. But they will try to figure out a way to get in and keep running the building. I think if the borrower realizes that there's no light at the end of the tunnel and like they just got to bite the bullet, they're either just going to stop paying and let them foreclose, or just hand them back the keys and walk away. And we've seen that a couple times.
Starting to happen. It's continuing to happen.
All right, guys, we're going to wrap up here in a second. But if we're sitting here kind of in December, 12 months from now, and you look back over 2024, what do you guys think will be the theme? 2023 was a little paralysis, right? We kind of talked about that.
Stability.
What you think stability will be the theme of 2024?
It'll all hinge on the Fed, but yeah, hopefully some stability with where rates are going to continue to go, and hopefully buyers can transact at a point where they feel comfortable both with lender execution and just interest rates.
It's starting to feel that already, right? Because
No, we feel it.
There's definitely
because like new buyers coming in and just more action, right? You guys have to.
Since New Year's, I mean, I would say we're pretty busy.
Yeah, everyone
Back to, like, what it
same
was.
with us.
We're seeing a
Our
ton of new
POV
activity.
count
It's
has gone like way up just in like the first few weeks of the year here. So we kind of feel it. Joey, what do you think? What are you most excited about for 2024?
I think there's more certainty around the market, and there's just more confidence in New York. Forget the rent laws, but in New York, and it just feels like more action, and that's what I'm most excited about.
Yeah.
Because Chris, I like the action.
You do. We've been on vacation with you and open bars. What guys?
Thank you for coming. Yeah.
Thank you very much for coming.
Thank
Anything that you guys want to share for 2024 that you think a borrower or bank should know, or like that you're excited about? Any kind of closing?
I think the
arguments?
biggest thing is like running a thorough process. No matter if it's us or anybody else, like you can't just go to the top 5 lenders that you used to go to. Like, if you really want to get the best deal in the marketplace, like you're going to have to run a thorough process. And
is there even a top 5 today? Right?
No,
so
that changes every month. So
it's
very fluid,
Yeah,
right?
very
and
fluid.
I think that's key for your business.
Process. It's all about process. Make sure you're running a very thorough process.
Yeah.
All right.
Okay, fair enough. It's kind of like like how we tell clients they got to update the BOV like every 90 days or whatever. It's it's really very much a nuanced market. Well, Steve, Chris, thank you very, very much for coming. You guys are awesome.
Thanks for having me.
Look forward to doing some business with you guys this year. Thank you.
Cheers.
Thanks,
What's up,
guys.
guys?